All right, welcome everyone. I'd like to thank you all for joining and participating. This is the Startup Grind Grand Rapids Real Talk office hours with experts in turnaround and crisis management, a series we'll be doing Monday, Wednesdays, and Fridays at 12 p.m. Eastern. Startup Grind is the world's largest startup community. We have over 600 chapters in over 125 countries. Our mission is simply to educate, inspire, and connect these entrepreneurs. We operate on three core values. One is to help others before you help yourself, give before you take, and then make friends, not contacts. Now, in that light, George Katsanos came out of, he was an inbound contact that saw what we were doing here in Grand Rapids and offered to help. He came and asked if I thought it'd be valuable and interested in hosting an update on global markets and having an expert roundtable where entrepreneurs and leaders could come and ask for actionable advice. The fact is, most entrepreneurs today, they didn't have to lead through the Great Recession. They did not have to lead through the dot-com bubble. They weren't even studying or haven't studied the market crash in the 80s. So how are they to be expected to do anything but follow their guts or the reactionary examples of their peers? The pandemic has been the great global leveler, and we need to be informed, rational, analytical, and rigorous in our thinking. I would like to introduce to you George Katsanos. And George, feel free to share your screen and get started.
Okay, righty-ho. What can you see on your screen at the moment, Corey?
I see your graphs.
Right. Let me start with, first of all, reading an excerpt from Kimberly Clark's earnings results last week. Looking into 2020, the company had previously issued its full year 2020 outlook on January 23rd, 2020. Due to the rapidly evolving situation, the high degree of uncertainty related to the duration and potential impacts of COVID-19 and the overall environment, including global business and economic activity, consumer and end market demand, global supply chain operations, and volatility in foreign currency exchange rates and commodity costs, the company is withdrawing its previous 2020 guidance and not providing any additional outlook at this time. The company is also temporarily suspending its share repurchase program effective April 24, 2020, for at least the remainder of the second quarter to enhance flexibility in the current environment. So what we have here is something that has become very common in companies reporting this season in the S&P, NASDAQ, and Russell 2000. Only about 1 in 5 companies still provide quarterly guidance. Almost every item on the income statement and the balance sheet going forward is questionable. So that has led us to think that the world economy has not assessed the effect of the COVID-19 pandemic properly. Some of you may have heard what the British Prime Minister said about endangering lives by opening up the economy too early. And I think that was a really wise decision. The key points that I would like to mention in today's introductory real talk is, first of all, we have cognitive failures. We think that we will return to the previous normal. We're suffering from status quo bias, hindsight bias, loss aversion, and herd mentality. Remember, these emotional predispositions prevent us from making rational decisions. It is clear that COVID-19 has been the great leveler. The pandemic represents a historic hit and an unprecedented challenge for policymakers and risk takers. And the reason we're holding this real talk today is because we as entrepreneurs are risk takers, and we have to be keeping an eye on all the markets around us, around the globe, because each one of them offers some valuable nuggets of information. It is worth pointing out that this crisis has led a profound structural damage to national and world economies. People, products, capital, and processes have been hit, and the result is significant dislocations that cannot be corrected from one quarter to the next. Which brings me to what people have been commenting on for quite some time, namely that they were expecting a V type of recovery. The sharp decline that we saw from February all the way to March, and then a sharp rebound. Well, if you look at the capital markets, and then we will come to that in a little while, you will see that this sense of euphoria is essentially reflected in the markets. However, we beg to differ. We think that not only are we not going to have a V type of recovery, we're not even going to have a U kind of recovery. And the reasons are many. First of all, it is tricky to start a world economy in an unsynchronized fashion. Even in the US, we have no synchronicity between the states. We will not emerge into what we used to know. Balance sheets will be different, the supply side will be different, and the demand side will be different. Some people think that the time to buy is now because they are, or they think they are, in a win-win scenario. They think they will win if we recover, and that means they go and buy whatever they buy in public markets, whether it's a company, stock exchange, an exchange traded fund, or whatever. They also think they win because they think that if the markets collapse, the Federal Reserve will come in and buy assets to support financial markets and the economy. There is two views that are emerging from watching the earnings reports in the last few weeks for the first quarter of 2020. There is a top-down institutional view that says, please look through the earnings seasons and be positive. However, there is a bottom-up view that is emerging from the CEOs of companies, the CFOs of companies, who do not have visibility. They look at cash flow and they scrap guidance. So as we're beginning this real talk over the next few weeks and months, we hope that we will be able to address some of these issues. For instance, moral hazard and bailouts against macroeconomic dislocation. What we need to be aware here is that in the past, some bailouts worked out well, but bailouts are tricky because of conflicts of interest. Entrepreneurs know and they feel it that this is not a one-round game. We cannot minimize structural damage overnight. When the decision makers start thinking about bailouts, they need to differentiate. Whom are they going to bail out? Why? On what terms? And what is the exit strategy like to be? The second point implicit with bailouts is generally the function of the markets. We know that encumbered financial markets are not functioning because the price signal is wrong. We also know that price is a clearing mechanism of supply and demand at any given time, given the latest available information. So if you start tampering with the financial markets, or any kind of market for this matter, you are actually going to have dislocations and you will have misallocation of resources. Zombie markets cannot allocate capital efficiently. Zombie markets create zombie companies. I think it is also clear to say, and probably we will not be wrong in supporting the view that the US will remain strong relative to the rest of the world. Rest assured, however, that we're going to have sovereign and corporate defaults. A wave is coming. Global risk is not uniform in terms of risk and reward. And the same applies to sectors of economic activity. Some sectors will be hit very hard, others less so. Distressed assets are likely to increase. Social unrest is also likely to increase. Cyber attacks and other forms of weaponry are probably likely to be used when world leaders are paying attention to the pandemic. We hope that what will emerge over the next few weeks and months is companies and leaders who will show resilience and agility. The last point that I want to make at this introductory real talk is that we all expect that we will bounce at some point. We don't know how and when. As entrepreneurs and risk takers, may I suggest that we focus our analysis on specific indicators when we're looking at opportunities, because opportunities will appear. First of all, cash flow and cash burn, especially deficits and shortfalls. If you're looking at municipal bonds, look at the underlying state and the issue very carefully. If you're looking at companies, look at the cash flow and especially the cash burn. The second big area to be looking at is and analyzing is the debt to be refinanced. What is the maturity of this debt? In which currency? Third, some companies will have access to capital markets, debt capital markets, equity capital markets. Some companies will go to the public markets. Some companies will go to the private markets. Companies in the US have the luxury of borrowing from a very large domestic market, and large corporates, those of the S&P 500, can borrow internationally as well. In your analytical tools, you should always have opportunistic positioning. As I mentioned before, you need to be looking at what you define as an opportunity carefully over time. You also are aware that those who will emerge on the other side of this tumultuous period are likely to experience a less competitive environment. I'm not sure that winner takes all, but there is little doubt, as we've seen in previous slowdowns and downturns, that the emerging companies will be stronger and in a better shape. Thank you, Corey. Anything else you would like to mention?
No, that's an excellent review, especially as we've discussed in the last weeks coming up to starting this series. So I do have we can move into some questions, I guess. We have someone on this call, and this is Sarah Hall. She's actually local to our Grand Rapids chapter here. She operates an insurance brokerage. And there was a piece I was reading in Axios over the weekend that was just starting to talk about what we should be thinking about as far as insurances and insurance companies, and whether they, like, how are they going to be able to move forward through this, specifically because with less people on employment rolls, less money going into the coffers of the insurance companies, right? And less people
Yes.
being able to be insured, and so on and so forth. So maybe you could maybe speak to that.
Yes. Is Sarah still online? Should I unmute her? Sarah, hello. I hope you're still online. You can hear me.
Yeah, George, I'm here. Hello,
Good,
how are you?
Good. Very well, thank you. Thank you for your question. I think the insurance industry is in a bit of a bind at the moment for a number of reasons. One, the premium for those who take insurance cover, but also the benefits have changed dramatically over the last 2 years. The second issue is that, particularly over the last couple of months, you must have seen a drop-off, a significant reduction in premium that you're receiving from your customers, your clients.
Actually, not actually.
Not yet. Okay.
Not yet. No, it will be a delayed impact. But as of this point, we work largely with small and mid-sized companies, 20 to 200,
Okay.
and a majority of them have actually almost nearly all of them have extended benefits for employees. So yes, we're a delayed impact, certainly.
The third issue is that competition will increase for you. In other words, what I have noticed is advertisements about insurance brokerage, newcomers, and so on and so forth are everywhere. What that tells me is that the insurance industry is bleeding. Now, the recommendation is, first of all, go to your existing clients and educate them.
Mm-hmm.
The loss of insurance should not be considered a luxury. In other words, it is fundamental to the well-being of the company.
Absolutely.
What you may want to consider is, just like we've seen in other parts of the financial community, delays and grace periods. Can your underwriter, can your insurance company afford to give a 1 month, a 2 month, a 3 month postponement of current premium without
Yes.
losing the coverage?
Yes, and that's what's happening pretty much across the board with the insurance carrier. We work with 26 different carriers,
Yep.
and that is a pretty consistent statement. Many of the ancillary carriers, non-medical carriers, are forgoing any increase for renewal this year, even those that were scheduled. So we are seeing some of that, certainly.
If you want to be a market leader, especially since you don't have to be on the road, you're working from home, so theoretically you are saving. My
Yes.
opinion is, if you want to be a market leader, take a 10% haircut, take a 15% haircut. You have nothing to lose.
Okay.
In other words, talk to your underwriters, talk to your insurance companies, and ask them to be brave. This is not the time to be greedy.
Sure. Absolutely.
And
Okay.
advertise this fact. In other words, your marketing should be what we call hand-to-hand combat.
Okay.
Right?
Yes, absolutely.
Another thing that I would recommend doing is what you may want to look into is colleges and universities. They are beginning to have issues of cash flow.
Okay.
Maybe you can tailor-made new programs for the coverage of faculty and or university. The hardware, the buildings, software, cyber attacks, you name it. You have ways to define what the opportunity is.
Okay.
If you're looking others for new customers, you should go into the higher education sector.
Okay. Noted. I appreciate that.
Thank you.
I think that's an interesting segue also to maybe touch on that, as that's hitting the news on almost every channel with the higher education.
Well, Corey, as we discussed in the past, the higher education sector is going to be transformed fundamentally. Not only because we will have to operate on a remote basis, but we will have to enhance the learning with additional components. And what do I mean by that? Forget about simply text. They have to be narratives that are far more innovative than maybe in the form of videos, and maybe be in the form of films, documentaries, and so on and so forth, that academics will have to bring to the classroom. However, we need to approach higher education as a business that has a low cybersecurity threshold. That needs to be increased fundamentally, because the students have to be able to feel secure, that their communication is secure, and so do the faculty. I think also we need to enhance access to sources of education. not only textbooks, articles, and so on, but whatever else we can put on in a library setup for students to access. And last but not least, we need to rethink the cost of higher education. We may need to consider downsizing the fees, these $40,000, $50,000, $60,000 fees per semester that some colleges are demanding. And last but not least, consolidation. I think we're going to see a lot of consolidation in the industry.
Absolutely. Just it's daunting the cut in enrollments that these schools are seeing, not just in summer but next fall, and then the expectation of students to even think of attending in spring. So it's very interesting to be watching. Lastly, we just have a few more minutes here. Something like really close to home here in Grand Rapids, in our ecosystem, we have a lot of different happy hours and access for entrepreneurs, business leaders to attend, but there's not a lot of insight on what to expect in the far term. So the majority of these people are in really, really small businesses. So we're talking $500,000 and less in revenue, employees of 1 to 20. And I saw a very interesting survey from Biz Buy Sell, the M&A website, which said that the majority of the respondents expected this optimistic outlook of a return to what they know is normal in 7 to 9 months. Maybe some just a general quick advice on even how to look at this data that you've mentioned for these small business operators who might not have experience or have never been called to be experts in epidemiology and so on, you know?
Well, small business entrepreneurs have to be brutally honest with themselves. They have to conduct what I call a 13-week diagnostic. Starting from today, they have to look at every week's income and expenses for the next 13 weeks and see if at the end of the 13-week period, they're in the red or in the black. If they're breaking even, only the red, they should close the business. If they're in the black, but anywhere between 5 to 10%, they should close the business. There is no point in having expectations that are unlikely to be fulfilled. When I look at the provisions that JP Morgan Chase and Wells Fargo made in their quarterly analysis, we're expecting at least 30% of mortgage holders to be in some form of default over the next 6 to 12 months. These are big numbers. We also know that when this either PPP money or the handouts are being given to entrepreneurs and to individuals, they tend to hoard them because the uncertainty is very large. So the consumer climate has changed beyond belief. In this regard, what I just want to mention here is this particular watch list. If you pay attention to the watch list, you will see that we are green here in the middle. SPX is the S&P 500. We're up 1.5%. DJT is the Dow Jones Transport, up 2.4%. DJI is the Dow Jones Industrial Average. We're up 1.3. And comp is the NASDAQ. were up 1.3%. RUTs, the Russell 1000, were up 3.7%. So you see that the market is actually looking very positively at the gradual opening up in Europe. Look at the DAX. The DAX was up today 3.1%. The UK was 1.6%. Italy, 3.09%. And Hong Kong, up 1.6%. Shanghai, 0.4%. On the other hand, you see the red here. These are the bonds. The bond market hasn't done anything. Down 0.02%, 0.15% for the 5-year, the 10-year 0.3%. So if the bond market is not selling off big time, that means investors who are investing in fixed income are far more careful about the prospects of recovery. And these are the signals that I slowly want to present to our entrepreneurs, managers, and owners of small businesses and large businesses, so that I can actually decipher what the market is saying. But rest assured that this green, this positiveness that we're seeing could easily evaporate if we have another second wave of pandemic attacks. The final point I would like to close this presentation with is a research paper that appeared in China, where Professor Li Langjuan and colleagues from Zhejiang University in Hangzhou analyzed the COVID-19 virus, and they discovered that there's 30 different versions of it. 30 different strands. In fact, what epidemiologists have discovered is that the coronavirus attacks in New York are very similar to those in Europe, where what we see on the western side of the US, in California and Washington, they're closer to the Asiatic strains of the virus. So we have a long way to go. We need a lot of testing available all the time. And whenever we go away, we need to be wearing masks. Thank you, Corey. I would like to thank all participants and wish them a healthy days ahead.
Thank you very much, George, for all the time that you spend putting this together for us. And then also, I know that you and I both want to invite everyone to share this opportunity to join us far and wide. We want this to be an international conversation because we are an international family. Also, the notes that you put together for this presentation and future presentations you're making available to us, they can be downloaded from the startupgrind.com/grand-rapids website. And with that, George, I really want to sincerely thank you for your time and commentary. And then we will see you again 12 p.m. Eastern on Wednesday. Is that correct?
Absolutely, and I look forward to that.
All right. Thank you all for attending. And with that, again, be safe.